In this week's update, odds still firming for a Nasdaq breakdown. No crisis here, just buy rotations and pullbacks in powerful uptrends. And the speed of change further elevates the importance of charts. My name's Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. Another volatile week keeps everyone on their toes. I want to go through a perspective which is pretty obvious but may not have occurred to most of the people watching this video. I think a lot of the issue with the volatility we're having at the moment is that the speed of change in technology is just occurring so fast that it's catching many of the players off guard. And that's forcing them to project forward. The market is always looking forward 6 to 9 months ahead. And because the speed of change is so quick, then those forward-looking anticipations are just not really keeping up with what the market is doing. The question, I think, is being raised all the time: who will be next? How far could prices fall? You can see it in the narrative every day. And then you add on top of that some excessive leverage, which has been getting progressively more and more in the system over the years. And the narrative really is struggling to keep up. So if you're trying to follow the narrative and expect to understand what is happening today, then you're playing the wrong game, because the narrative is telling you about what has happened in the past or what is happening right now, but it doesn't really tell you very much about what the major players are anticipating about the future. Are they right? Are they wrong? Only time will tell. So to a degree, markets are jumping at shadows, and that's causing some of the extraordinary volatility. And with Australian earnings season underway, we're seeing some enormous reactions that you would never see from top 100 stocks in terms of percentage. I can't remember a time when I've seen as many really large moves, and many of them are negative. So any sort of little miss at all, and the market is going to absolutely slam the share price. The reality is that the fundamentals, so if you're looking at the financial metrics, the fundamentals are too far behind. They're months and months behind at pivotal points in the market. So if you're basing your decisions to buy and sell off fundamentals, then you're just in a different time zone altogether. So the overwhelming emphasis, and I'll say this pretty much every week in all sorts of different ways, and I've been doing so for years, the overwhelming emphasis has to be on where the money is flowing now, and even more so now because things are moving so much quicker. And just to give you an idea of what some of those things look like, let's just look at the areas that are being affected, particularly by the anticipation of what AI might do to these areas of the market or these areas of business. You look at US software. So these are ETFs which are broadly covering these areas. So US software is in really strong downtrend, and you can see the volumes associated with them have really spiked up. And just looking at that chart, you would have to conclude that the chance of this 200-week moving average breaking are pretty good. And we've already gone through one very significant support level, like it wasn't even there. So the momentum is absolutely to the downside. And you'd just be guessing if you tried to figure out where the bottom is. So that's software. This is US cybersecurity. Hasn't fallen as far yet, but we've been saying that about a lot of technology sectors for many, many months, and they just keep falling and falling and falling with no apparent sign of putting in a base. This is cloud computing ETF, SKYY. It's also perhaps a little bit earlier than the software sector, but there's no way that you can say that that is not going to fall much, much further yet. Coming closer to home in the Australian market, a number of really great businesses with terrific long-term outlooks are getting absolutely smashed. 360 is down from $56 down to the low 20s. And there is a simple way to own this, which I'll come back to during the presentation. You don't have to avoid these stocks. It's about how to. This is Zero, another former market darling that's just getting absolutely murdered. It was trading at almost $200 and now it's trading in the mid-70s. Car Group, another excellent business. But you look at that chart, how much further could it go? No idea. It could be significantly further because you've got to remember that markets have a habit of overshooting in both directions. And REA Group, another very, very good business, but it's just completely offside with the market. And it's fallen from around 270 and we're now down to around 150. Now, there's not a lot of investors that have got the stomach for that sort of volatility, and you don't have to. There is a way to get around this. So would you rather be stuck in stocks and sectors that are doing this, that are falling and falling sharply week after week? Or would you prefer to be in trends that look like that? And there are a number of them. This is GDX, gold, but also we could look at, and I've shown this a couple of times in recent weeks, this is XLE. Now, I think viewers would understand my view of the energy sector, certainly in Australia. It's a sector that I don't really touch because of all the uncertainties. But this is XLE in America. Now, the fundamentals don't really support a breakout, but the breakout, so in other words, there is more money flowing into this sector now than into other sectors. The breakout is on and it's robust. And I'll just tighten in on this. So this is a very significant breakout we've just seen. That previous peak goes back to July of 2014. So this is a very robust breakout and the volumes have really gone with it. So this is the market reality. And whether I like it or not, whether it fits with my fundamental view of the sector, this is what's happening. Prices are going up. Individual stocks are going up far more quickly than the index by definition. So this is where the momentum is. This is where money can be made. So if you want market success, then you've just got to get past owning your favorite stocks or household names, the conventional wisdom stocks, or even worse, and I'll come back to this, the so-called blue chip stocks. We've seen a number of blue chip stocks blow up in the last couple of weeks in the Australian market. You don't have to own these stocks. And I think the reason a lot of people own them is because they don't really understand where to go to get good stocks that have got good momentum now. So for me, this is about what's working, what's not working. We avoid what's not working and we do more of what is working. The fundamentals, so high quality fundamentals, and plus the 6 or 7 mega trends, depending on how you want to define them, puts you in the right fishing holes. But that doesn't mean you have to be in them all the time. You can shift your weightings around. You can get out of some sectors completely for a period of time. Just don't lose sight of what the big picture is. So I'm not saying that fundamentals are not important, because they are for the longer term. Earnings growth still matters. But if you've got terrific earnings growth, but you're coming off a very high multiple, like some of the stocks in Australia, then they've already fallen 50%. And who's to say they won't lose another 50% from here? So from here, the most important thing is short to a degree, but I'm not a short-term trader. And this is not about being in and out of the market constantly. This is about observing where the current medium-term powerful trends are and overweighting those parts of the market. So if you look at AI at the moment, it's being called into question in all sorts of areas. And it's really, the negativity has really accelerated quite dramatically in the last couple of weeks. Now, AI is not going away. We all know that. It's going to be with us. It's going to be an extraordinary mega trend for years and decades to come. But you don't have to be in it right now at a high percentage. The risk for reward is just not worth it. The momentum is heavily to the downside. And because of the speed of change, I think we're almost certainly going to see some significant overshoots to the downside. So that is a great opportunity, but you don't want to be necessarily heavily weighted to it right now. So this is a matter of adjusting weightings, just being organised. So we've been, as everyone knows, we've been in a global reset, value reset, which has been centered on software and technology, has gone into some other areas, but that is where it kind of started and is still centered. And on top of that, we're getting increasing fears about the amount of money that big tech is planning to spend on CapEx. And just in the last week, we've seen projections where those CapEx numbers just keep going up and up. And the market is getting a bit nervous about that, what will be the return from that enormous investment, and also just about the whole circular funding debate with companies like NVIDIA funding other companies to buy their product. Does that eventually implode or does it not? Does it somehow work out? Are these guys smarter than we are? So the market appears to have shifted into a who could be guilty kind of thinking rather than who's innocent. So I think everyone that's in an area of uncertainty is being marked down sharply just in case, and that's because of the volatility and because of the margin calls. So we've got logistics software, we've got legal, we've got companies running software as a service models, we've got fintech platforms, companies that do coding assistance or analytics or asset management or real estate. These are all areas that are being called into question. Who could be next? And no one really knows, but the fear is the same, that AI is going to end up causing margin compression for these stocks. Now, no one knows whether this is valid or not, but the market is jumping at shadows. No one wants to get caught. So the answer is not trying to figure that out. Will it occur or not? The answer is to be on more of what is still in a powerful uptrend and less of those sectors and stocks that are not. It's a pretty simple conclusion when you stand back and look at it objectively. Thinking out over the next couple of years, I think the call is pretty easy. So I'm not saying that this is anything earth-shattering. I think it's pretty obvious. I would expect that we're going to see some modest corrections in the US indices throughout this year. And the reason that I think they'll only be modest is because we've got this bifurcated market where part of it is going up at a rate of knots and part of it is going down at a rate of knots. And so you put that together and the indices are not going to do anything dramatic when you've got that kind of market. Part of it going in one direction, part of it going in the opposite direction. So I think we'll just see some modest index corrections, which means that the overall sentiment and tone for the market globally should remain reasonably okay. Now, that kind of market, which is going in two completely different directions, creates really big opportunities. It's just a matter of being organised and understanding what the opportunities look like and where they are. My advice, because things are moving so quickly, is that you should examine every household name that you own. The stocks that everyone kind of nods and accepts are the sort of stocks you should own because everybody else does. Or any stock which is part of conventional wisdom. Now, you should own a bit of this and a bit of that. You may as well get the majors. I would be examining every stock that I own and looking, first of all, at the big picture current trend. Look at a weekly chart. Is it going up or is it going down? Which way are the moving averages pointed? Just keep it really simple and big picture. And if the chart is going down, if the price is going down and has rolled over, then you really got to ask whether your current weighting is appropriate. Commodities will obviously remain volatile because we're getting a lot of leverage in the system and then the market gets ahead of itself. That leverage has to unwind. But overall, commodities, the overwhelming odds are they're going to move significantly higher. We've also got, particularly in the precious metals area, we're still lagging significantly on valuation. Now, that doesn't mean that it has to catch up, but the probability is that the valuations will catch up to where they normally are as we progress through a really bullish cycle in precious metals like we saw in the 2000s. If you've got the capability, then I would be long the stocks that are in powerful uptrends and be short through whatever mechanism you use the stocks that have got negative momentum. And that gives you that balance between what's working, and you can have, if you get it right, you can have both parts of the market working for you. In a market like this, you really need to be organised in all respects. So make sure that you've got all the financial and legal and any other advice that you need before embarking in the stock market, because this is not going to be an easy market. I think it's going to be a market in 2026 of tremendous opportunity, but it's not going to be easy because of the volatility and because of the abrupt changes. Turning now to American stocks, the S&P was down 1.4 for the week. The Nasdaq fell again, down 2.1. And I'll visit again the theme that I talked about last week, in that the character of the US indices is just changing enough to pay respect to it. The Russell 2000 was down a little bit, but plenty of volatility there in the Russell. And the equal weight S&P, the RSP, was even, so it outperformed the S&P. And that's the positive, one of the several positives in the US market. And that's the breadth is holding up very, very well. There was a benign inflation report towards the end of the week, so that's good news. That means there's less impediment to cutting rates, and the market loves cutting rates. Earnings growth is holding up quite well in the US. Yes, we have rising volatility, but with that breadth, there's an enormous number of really strong, sustained uptrends. When you put them all together in a watch list, as I do, 150, 200 stocks in a watch list, and that's all you're looking at, powerful uptrends, it really gives you a sharp perspective of where the opportunities are in the market. Now, the US dollar index, and that's going to be one of the big drivers, I think, for the next 2, 5, perhaps 10 years. So it continues to look negative. 10-year yield fell from around 4.2 last week down to almost 4, and the VIX did spike up and finish the week at 20.6. Well, let's start with the Nasdaq. So I just make an observation. This doesn't happen the same way in any two cycles and doesn't necessarily have to happen, but it often works out this way, that big tech leads in the accumulation phase. This is a weekly chart of the Nasdaq. Here's where we were at the bottom of 2022 after we had that significant move down from around 16,000 down to 10,000. That's a big move in an index like the Nasdaq. So that was 2022. Big tech just ground lower and lower and lower. But since then, it's turned around and it's been ascending at a very, very strong rate. But we've now got a different pattern emerging. And this is often how it works, where we get a long distribution phase. So big tech often leads in the accumulation phase down here, and then it tends to lag in the distribution phase when institutions are rotating, either reducing their exposure if they think there's a recession coming, or rotating their exposure into other sectors where they see better opportunities. And because big tech tends to lag during that distribution phase, you often get this pattern that goes on for months and months, where it's just a series of seemingly running tops before we get the rollover and the breakdown. And I think each week, this moves just a step more in that direction. Now, the bottom line is we can't know in advance, and it's silly even thinking about it. All we should be doing is just observing and addressing our weightings and ask them if they're still appropriate. So I would be overweight in what is in current strong uptrend, and I would tend to be underweight, not just anything, but underweight in great long-term businesses that are not trending at the moment. And as I said, the positives, there are still positives in the US market, but big tech is going to have an outsized impact on the Nasdaq and on the S&P. Earnings are good. Go where the multiples are acceptable. Find strong existing upward momentum. Don't try and pick bottoms in the market. That's a low probability exercise. Might make you feel good if you get to pick the bottom in something, but it's very, very difficult to do with any level of consistency. This is the NASDAQ versus the S&P. So we're seeing growth breaking down. This is just one way of depicting it. There is more defensive stocks in the S&P proportionately. So we're seeing the NASDAQ doing worse. And this is a definite change in character. Now, I don't know how far it'll go, where it'll end, but there's no question this is a change in character. If we look at consumer discretionary versus consumer staples, this is a dramatic change in character. The market is moving much more defensively. There was just almost no bounce here at all. A bit of good news, semiconductor ETF is still holding up really well. So semiconductors are still doing well. And that's important because some of the world's biggest companies, in fact, the world's biggest company, NVIDIA, is in the semiconductor sector. So that's a positive tick for the market. Let's look at it on a sector basis. XLB, which is materials in the States, which is a very different mix in its index than what we've got here. This has got steel and aluminium and a number of sectors that we don't really have much representation here for. But you can see we've got materials, we've got energy has roared up from the bottom. It was only back in December that energy was trading at the bottom of the totem pole, and now it's second in line. XLP, consumer staples, has also rocketed up the list. So this market rotation has changed things enormously. So the top four, materials, energy, staples, and industrials, all in uptrend, all in really strong uptrend. The bottom ones, healthcare, and then we get into the more aggressive sectors, communication services, the S&P itself, consumer discretionary, the banks, which are certainly weaker in the States than here, and then technology right at the bottom. In the Australian market, materials has done very well. This is a bit misleading because we've just got this domination of 3 or 4 huge stocks that really distorts everything. So this index is really about what BHP and Rio are doing rather than perhaps a lot of the stocks that we're involved in. Finance has picked up. The banks had a decent week. So they're the only two that are outperforming the ASX 200. Energy falling off a bit. I covered this last week. Australian energy stocks are dramatic underperformers compared to US energy stocks. Small caps have had a tough few weeks. And then healthcare has absolutely fallen out of bed. Their results during earnings season precipitated some very big falls. And the IT sector just continues to get pummeled, far more than anyone would have thought. The S&P is on a weekly chart, so it's just got the appearance of rolling over, but our eye can often deceive us, what we want to see. So it's important to try and remain objective and just look at what is. So at the moment, the S&P is just hanging up there within a whisker of all-time highs. That's about all you can say about it at the moment. But this is the RSP. So it was even on the week, but it set new all-time highs and really good volumes behind that. The Russell, of course, gets pretty volatile at times like this, but it's still trading almost at its all-time highs. So just recognise where the momentum really is in this market. Turning now to the Australian market, our dollar finished up at 70, and we'll look at the currencies in a minute. And that's up 11% year to date in 6 weeks. The ASX 200 was up by 2.4% for the week. Materials and banks led the way, and information technology just continues to get hammered, as we saw. Healthcare, an absolute shocker. And I'll get to this term that has really got up my nose for a number of years, and that's this term blue chip. I mean, what the heck does that mean anyway? Is owning blue chips supposed to protect us from rapid swings or from loss of money? Because we saw in the last few days or couple of weeks, we've seen 30% swings in some of the biggest stocks on the market, some of the real blue chips, considered blue chips. And there's the list there. And there are many, many others. So what does this term blue chip mean anyway? And should you be paying any attention to it when you're thinking about what should be in your portfolio? So from my perspective, I think any household name, commonly held stock that everyone doesn't kind of really think too much about, they just own it because everybody else does and brokers tell them they should. I think household names should be viewed as guilty until proven innocent. Make sure that they're doing what you think they're doing. Well, let's go look at the charts on the Australian market. So the ASX 200, not a bad week. We finished off the highs, which were basically the all-time highs as well. But that is certainly a bit more positive than what we saw in America. And I haven't been able to say that too many times in the last year or so. This is XJR, which is the resources index on a weekly chart. And that's materials, which looks very similar. The other one I want to look at is XEC, which is the emerging companies. So that had two very, very sharp sell-off weeks. We had a rebound of sorts, but got marked down again on Friday. Turning now to precious metals. Gold was up 1.5% for the week, finished above 5,000 again, and still holding nicely above its support zone. So this is albeit pretty wild consolidation, but it's nevertheless, it's a consolidation within a really powerful uptrend. And all the drivers are all lined up saying that that uptrend should continue for a long, long period of time. Translated to Australian dollars, 7131, so very profitable territory for our miners. Silver was down 1%. It was super volatile again, and there was one 30-minute period when the price of silver fell very, very sharply. It was down some 10, 12%. But it's also still holding its support zone. And in comparison to gold, it's pretty much doing what you'd expect it to do. Now, it's worth noting that the Shanghai Futures Exchange is going to be closed for the Lunar New Year. So it's likely that we could get a bit of selling, but we certainly won't get, I don't think, much in the way of really strong buying. So we may get some better opportunities in terms of buying entries. So that's something to keep in the back of your mind for the next week or 10 days. With gold stocks, GDX in Australia was up 6.4% for the week, and GDXJ listed in America was up 5.8%. Now, every cycle in precious metals is different, but when you look at the fundamentals around gold miners and the fact that I believe we're still in the early innings of gold and silver moving higher, then we're at a point now where free cash flow, this is not operating cash flow, this is free cash flow, valuations are far lower than they were in the 2000s. And the long-term cycle at the moment, what all the indicators are pointing to is that that cycle could be longer and stronger than what we saw in the early 2000s. And over recent weeks, I've been covering the reasons for why, those big picture reasons, the de-dollarization, the movement away from US assets, all those sort of big picture drivers that weren't there in the 2000s, they're loaded on top as well. So it's an exciting period ahead for the next 5 or 10 years for precious metals. But again, it's important in the how-to. Let's go and look at the charts. Start with silver. This is the support zone, the likely support zone. So we've had a plunge through it intraday, but rallied back. And last week, the volatility settled down a bit. It got pretty wild and woolly there on a couple of occasions, but it did settle down a bit. So it's holding that support level. Gold, the support level is between 4,300, 4,200 and 4,600. So in that range there, it's easier to see on a daily chart. So here's our support zone on gold. So that's the obvious support zone there. We had a dramatic plunge into the support zone the week prior to last. And since then, it's held up very well. And in fact, you'd say there's really an uptrend in place in the very short term. In Australian dollars, still looking really strong. And when we look at the spread, US gold versus silver, we've got silver underperforming, but we know that. We just look at the charts. We don't need to look at this one for clarification. Now, I want to look at Bitcoin. So there's a glitch in the data here. This is a weekly chart of Bitcoin in US dollars. So try and ignore this big plunge, and I'll show you another chart in just a minute. So ignoring that, we've broken vital support here around 74,000, traded down the previous week as low as 60,000, had a little bit of a rebound to close to 70,000 last week, but certainly the trend is down, lower highs, lower lows, and strongly down. So that's what the chart looks like. This is a 10-year chart, and you can see we've broken important lows. We've broken this major swing low here, and we're certainly in medium-term downtrend. Now, who knows? Maybe this is the bottom, maybe not. But certainly what you can say about Bitcoin is, and the other cryptocurrencies, is that right now, the momentum is dramatically to the downside. So I'll just leave you with that thought in terms of how you're weighting exposure in that sector. We're going to look at currencies. This is DXY, and it's quite clearly in downtrend. We're still consolidating, but we're getting lower highs and lower lows as well. So all the probabilities are that the US dollar will break this support level, and that is almost certainly to bring a flurry of additional pressure on the US dollar. And the Australian dollar is naturally going in the other direction, and certainly helped by commodity prices as well. Speaking of which, copper slipped a little to 579, but this is just a pause, a consolidation in what is a long-term structural bull market. And you'd have to think that we're looking at least 10 years plus. Crude oil was down a bit from last week, 62.81. But as I showed earlier, if you look at the energy index, XLE in America, we've now made a sustained breakout above a 12-year high. You can't ignore that, even though the fundamentals don't necessarily point that way. That is where the momentum is going. There's the copper price. So we've come off a little bit, but this is looking very much like a consolidation zone above the prior peak that we saw back here. This spot uranium, we were down to 85 last week. We rebounded to almost 90. So wrapping it all up, the final message is this volatility is a bonus if you know how to exploit it. If you don't know how to exploit it and manage it, it's frightening. It's really frightening. And you'll find yourself making all sorts of crazy decisions that you shake your head at later. But that's what this level of volatility does. It's just so important to be organised. If you bring a set and forget, I'll just be in this for the next 5 or 10 years type of attitude to the market, then you're going to get whatever the market delivers. If you're happy with a 5 or 10% return, then fine. Keep doing what you're doing. But if you want to outperform, then you've got to be smarter than that. You've got to be more agile than that. And you need to bring a different attitude and a different set of skills. In my opinion, the pathway is really quite straightforward. It's crystal clear to me what needs to be done. It's just organisation, shut out the noise, get rid of some conventional thinking, and just get on with it, because there are terrific opportunities. There's more information on our website, and there's my email address, and I'll be back with you next Sunday. Cheers.